Welcome to Investing Insights. I'm your host, Ivana Hampton. Morningstar's 2026 Global Investment Outlook is offering investors tactics to weather whatever the future may hold. And the next episode in our series is focusing on finding opportunities in a concentrated market. Here's a question. Is your portfolio making a big bet on the Magnificent Seven? Mega cap names like Nvidia, Alphabet, and Apple belong to the exclusive club that has largely driven U.S. returns higher in recent years, and their success has led to market concentration. Portfolios tracking broad benchmarks have seen their diversification decrease and risk increase. How can you prepare your portfolio to absorb potential shocks? And where are the opportunities beyond the Mag 7? Morningstar Holland's chief European market strategist, Michael Field, is one of the researchers who has investigated this. Thanks for joining me, Michael.
Thanks, Savannah, for having me back.
Well, the Magnificent Seven's strong returns have benefited many investors. Why is their dominance a risk?
Yeah, it's a funny thing to be questioning why we're getting such good returns. But I think the problem is if we become over-reliant on the returns from these seven companies.
Your team highlighted a noteworthy stat in the report. The top 10 U.S. stocks make up about 35% of the overall market. That's almost double from a decade ago. What does that signal to you?
So I think you hit the nail on the head there. It's not just that it's 35% and growing. It's the fact that it's risen so quickly is slightly concerning, and whether those companies can maintain that or whether there's going to be a fall at some point and we're going to be giving back some of those gains.
Can you explain what the hidden cost of market concentration is?
So in a word, it's risk. So it's great to have the reward, but what are we risking to get that? And if indeed we've got, more than a third of our market caps, generated all on one sector, then that's a huge bet, particularly now on AI as that ramps up. So great. If it works, we're all going to make a lot of money. But if it doesn't work, then we've got the potential to lose a lot of money also.
If the top stocks hold so much of the gains, where does that leave the rest of the market?
And this is a very good point and something we've commented on in the past after earnings seasons, where we've seen 493 of the S&P 500 basically report no earnings growth, yet the index is just being carried by those top seven companies. And again, that's great if they're growing, but the risk is if they stop growing for whatever reason, then we really have to take a good hard look at the index and see, okay, is there any other growth?
Let's focus on key periods of market concentration. How does the current environment compare to the dot-com bubble?
So you spoke about it a few minutes ago. The rate at which it's ramped up is very similar to the dot-com bubble, which is a little bit worrying. Dot-com bubble over 4 years, it went from 15 to 24%. And we're even more concentrated now. And again, it's on specific sectors. So from a risk perspective alone, just looking at market concentration, it is slightly concerning.
And what about now versus the global financial crisis?
So a different set of circumstances. The GFC, a lot of bad things all happened at one time and valuations were stretched at that time across the entire index. And that's probably where the difference is. If we look at valuations now, we still see upside to the US index and we still see upside to most of the Mag 7. So from that perspective, it doesn't look like another GFC, thankfully.
What if investors pull back due to market concentration concerns in the last decade? Why would that have backfired?
So certainly if you look at the gains that were made, Nvidia's up 13-fold over the last 5 years, and it's really driven markets. It's 8% of the entire US index at this point and about 6% of the Morningstar Global Index. So it's huge. And that's just reflective of those huge gains that it's made. Had you pulled out of that, had you been concerned at the time, you would have been missing all those gains. And if you're a fund manager, you probably wouldn't be managing money anymore.
How can investors manage the risk of market concentration in their portfolios?
So this is, again, something we dealt with in the report, and we asked that very same question. It's fine to be exposed to Nvidia and the Mag 7. It's hard not to be exposed. But first, you need to be very much aware that exposure and not taking on extra exposure to those stocks unaware that you have it already. And two, you can diversify also. We noticed opportunities across the board, Europe and in other places, that you can look to diversify your exposure.
And we're going to get into those opportunities. Morningstar has identified investment opportunities for 2026. Why does the team favor U.S. small caps over U.S. large caps?
So certainly US large caps have been growing more strongly over the last number of years, again, driven by the Mag 7 to some degree, but also concerns about the economy. So whenever investors are concerned about the economy, they gravitate to those blue chip perceived to be safer stocks and away from smaller stocks. But that's opened a valuation opportunity now that we think investors can take full advantage of.
And another opportunity is the healthcare sector. What companies do Morningstar analysts think could fend off the competition for 10 years or more?
So there's a whole host of healthcare stocks at the moment, both in the US and in Europe, that investors that can take advantage of, that the valuations have dipped. And most of these are very much wide moat stocks. In Europe, the likes of Roche, GSK, Novo Nordisk, to name another one. So there's a whole host of it, and exposure across the pharma care industry. So it's not like you're taking on one specific sector or risk either.
And Morningstar encourages international diversification. Can you talk about the regions outside the U.S. that look attractive for stock investors?
Yeah, so certainly emerging markets are looking attractive again now as the dollar has fallen. That's kind of helped that situation to some degree as well. Brazil, Mexico, for instance, are looking attractive. And then closer to where we're based in Europe, you've got markets like the Netherlands and Denmark, which are looking particularly attractive also.
And what's the takeaway for diversifying beyond the Magnificent Seven in 2026?
So again, be aware of it, number one, be aware of that exposure, and then really try to take advantage of those opportunities when you can, not only because the valuations are attractive, but because they're also giving you that diversification that you probably need the most in 2026.
Thank you, Michael, for your insights on how to invest in a concentrated market.
Thank you.
That wraps up this week's episode. Thanks for making this show part of your day. A couple of reminders. Give Investing Insights 5 stars on Apple Podcasts to help others find the work we're producing for you, and subscribe to Morningstar's YouTube channel to watch new videos from our team. Thanks to senior video producer Jake Van Kersen and associate multimedia editor Jessica Bevel. I'm Ivana Hampton, lead multimedia editor Morningstar. Take care.